Hello. Following on from the email we sent out on Friday afternoon regarding the coronavirus and the downturn in global markets, I wanted to get in front of the video and just put this into a little more perspective for you. We are all aware that share markets have fallen on the back of the coronavirus concerns. 2019 was an unusually strong year for equities and defensive assets such as government bonds, both delivering returns well above long-term averages. We also began 2020 thinking that an equity market correction was likely in the short term, but couldn't really think of a catalyst. The Australian market had a dramatic turnaround yesterday and recovered really well from earlier losses amid hopes that the Reserve Bank will cut interest rates again today. US and European stocks rebounded overnight, and the Australian market is up 2% at the moment. Market corrections are normal. Share market downturns also provide opportunities for investors to buy stocks more cheaply. While stock prices may have fallen, dividends lessen the fall. The Australian market is still higher than it was 6 months ago, and this doesn't include dividends. While the coronavirus is being taken very seriously, so far the virus has led to around 3,000 deaths. To keep this in perspective, the 2017 World Health Organization study attributed between 300,000 and 650,000 deaths per annum from the annual influenza virus. The Australian dollar has also fallen by around about 6% since the 1st of January this year. The fall in the Australian dollar is a positive for all Australian exporters. The world has seen many epidemics in the past, such as SARS, swine flu, and Ebola, and they all tend to be short-lived due to the advances in treatment and vaccine development. Travel and tourism industries have been impacted. With China being a manufacturing hub, the closure of cities and factories has hit the global chains hard, restricting business activity. In times like this, we must remind ourselves of the basic fundamentals of investing. Balance and diversification is key in volatile markets. Your portfolios are invested in a wide mix of all assets. While one part of your portfolio may suffer losses, other investments remain stable or even increase in value. History has shown time and time again that changing a long-term investment strategy during times of short-term volatility is not usually a smart move. We actually factor market fluctuations into your investment strategies. Share markets are doing what share markets do. They go up and they go down. The trade-off for sticking to your long-term strategy is that you will be rewarded on the upside. We aren't going through anything that we haven't experienced previously in share markets. It's not the quality of your portfolio that causes volatility, it's investor emotions that create volatility. As always, if you have any real concerns, please be in contact with us as we're here to help and guide you. Thank you.